Now that we are approaching the end of the year 2022, you might be wondering if there is anything that we can do in our portfolio to save on our taxes, especially when S&P 500 has gone down by 17% and Nasdaq 100 by 30%. Yes, there are ways. It is called tax loss harvesting. But not everyone can take benefit from it. Why? We'll take a closer look at it in this episode. Hello everyone, my name is Vijay Mohan and you are watching Investment Insights. Use this episode as a general guidance to understand the capital gains tax in the US, not as a tax advice. Always check with your tax advisor for your tax planning. We'll start with how capital gains are taxed in the US. A taxable event is triggered only when you sell a security, like a stock or an ETF. Buying a security or holding a security on gains, they are not accounted for tax purposes at all. But when you sell a security, you are going to realize a gain or a loss, and that is why it is a taxable event. When there is a gain, we have to pay tax on those capital gains. There are two types of capital gains, a long-term capital gain and a short-term capital gain. If you sell a security that you have held for more than a year, then the gains from that sale will be a long-term capital gain. But if you held it for less than a year, then the gain will be a short-term capital gain. The tax rates are different for both. What we are seeing here is tax rate chart for long-term capital gains. If you are married filing jointly and if your total taxable income, including the capital gains, is less than $83,000, then your long-term capital gains tax rate is 0%. But if your total taxable income, including the capital gains, is more than 83,000 but less than 517,000, then your long-term capital gains tax rate is 15%. An example can help us to understand this better. Let's say that you sold an ETF for $10,000 on December 5th, 2022. You bought this ETF for $8,000 in November 2021. The gain $2,000 from this sale would be a long-term capital gain because you have held the ETF for more than a year. So now when you file the tax return for 2022, you need to report this gain $2,000 as long-term capital gains. Now the tax rate for this gain $2,000 depends on your total taxable income, including this gain $2,000. So if your total taxable income, including this capital gain $2,000, is less than $83,000, then you do not have to pay any tax for this capital gain at all. This is assuming that your tax filing status is married filing jointly. But if your total taxable income is more than $83,000 but less than $517,000, then your capital gains tax rate is 15%. That would be $300 tax on $2,000 gain. What if you held this ETF for less than a year? Let's say that you bought this ETF in October 2022 for $8,000. You sold this in December for a gain of $2,000. Because you held this security for less than a year, you will be paying short-term capital gains tax rate. And the short-term capital gains tax rate is your marginal income tax rate. That means you will pay tax on the short-term capital gains as if you have earned that income from your full-time job. If your family income is between $83,000 and $173,000, then your marginal tax rate is 22%. That means you will be paying 22% tax on any amount that goes over $83,000 in income. So in our example, the $2,000 short-term gain will be added to your regular ordinary income and will be taxed at 22%. If your ordinary income is even higher, then you will end up paying a higher tax rate for short-term capital gains. This is all good for gains, but what if there is a loss? How do we handle that? Losses need to be handled in 3 steps. First, deduct the loss from similar gains. Long-term loss should be deducted from long-term gains. Short-term loss should be deducted from short-term gains. If there are still more losses, then those should be deducted from any type of other gains. Meaning, a long-term loss can be deducted from a short-term gain or a short-term loss can be deducted from a long-term gain. Finally, if there are still losses left, then up to $3,000 can be deducted from our regular ordinary income and the rest can be carried forward to the next year. Again in the next year, the same steps are followed. If we do not have enough gains next year to offset the losses, then again $3,000 can be deducted from our income and the rest can be carried forward again. Losses can be carried forward indefinitely. There is no time limit. I know that it is a lot to take in. Let's see this through an example. You make 3 trades in the year 2022. a long-term loss of $6,000, a long-term gain of $1,000, and a short-term gain of $1,000. The long-term gain 1,000 can offset part of the long-term loss 6,000. So that would result in a net long-term loss of $5,000. But we still have a short-term gain of 1,000. The rest of the long-term loss can offset this short-term gain as well. So the final loss comes out to be $4,000. The whole $4,000 loss cannot be deducted from our regular ordinary income. IRS lets us deduct only up to $3,000 of capital loss per year, but we can carry forward the rest of the loss $1,000 to the next year. So if your regular income is 100K, then you can deduct your loss 3,000 from 100K and pay income tax only for 97K. Now you should have a good understanding of how long-term and short-term capital gains tax work. On to the main topic now, tax loss harvesting. Tax loss harvesting is a strategy that we can follow to minimize the capital gains tax by offsetting capital gains with capital losses. For example, say that you sold a few securities in your portfolio and realized a total long-term capital gain of $5,000. Then you have to pay a long-term capital gains tax rate of 15% on those gains, which will be $750. But if you already have securities in your portfolio that are at loss, then you can sell those and realize the loss so that you can offset these gains. If the total loss is $5,000, then you have zero gains for the year and so no capital gains tax. You saved $750. Not bad, huh? But there are a couple of problems with this approach. We cannot buy the same security that we sold for a loss for another 30 days. That means if I sold the ETF QQQ for a loss and if I want to show that as a loss in my tax return, then I should not buy QQQ again for the next 30 days. It is called the wassail rule. If I buy the same QQQ within next 30 days, then I cannot claim the previous loss in my tax return. A long-term investor should always be invested. We cannot sit out of the market even for a few days. But this wassail rule is forcing us to sit out of the market for 30 days. What can we do? There is a workaround. Instead of buying the same ETF, we can buy something similar but not substantially identical. For QQQ, we can potentially replace it with VGT, Vanguard's technology fund. But we cannot replace QQQ with QQQM as they both are substantially identical. So we do have a workaround for the wassail rule. The second problem with tax loss harvesting is we are not actually saving the tax. We are just postponing the tax payment. That is all. This might come out as a surprise for many. Let's look at an example to understand this better. We sold ETF 1 to realize a profit of $5,000. We have ETF 2 which is at a loss of $5,000. To avoid paying tax for the $5,000 gain, we are going to sell ETF 2 at loss. Now we have zero gains for the year and so no capital gains tax. Well and good. But by selling ETF 2, we get $10,000 in hand. We use that money to buy another similar ETF, ETF 3. Let's say that we hold this ETF 3 for the next couple of years. In these 2 years, the ETF 3 has doubled in price. We decide to sell this ETF 3 in 2024. Now the profit is $10,000. If we have held on to ETF 2 without selling, that would have raised to $20,000 as well. Its profit would have been just $5,000 as the cost of acquisition is $15,000 for ETF 2. But because we switched ETF 2 with ETF 3, we end up with the bigger profit of $10,000. So the 5,000 capital gains we saved in 2022 will catch up in 2024. That is why we are saying tax loss harvesting is not actually saving taxes but just postponing the tax payment. But still, under certain circumstances, we can use tax loss harvesting to our advantage. We can try to deduct $3,000 of capital loss from our regular ordinary income every year. Let's say that you own some securities that are at loss. You can potentially sell them to realize a loss of up to $3,000 and replace them with something similar but not identical. Now this capital loss of $3,000 can be reduced from your ordinary income. That means if your marginal tax rate is 24%, you are saving $720. Higher your marginal tax rate, higher will be your savings. This is one strategy. Another strategy is to extend this for multiple years. Say that you have a capital loss of $5,000 in your portfolio. What you can do is, you can sell your holdings and realize the $5,000 capital loss now. Get the tax deduction for $3,000 this year and carry forward the remaining $2,000 into next year. Assuming that you do not have any other losses, You can deduct this 2000 from your income next year. If your loss is huge, you can repeat the same process for multiple years because we can carry forward the losses indefinitely. Another reason to do tax loss harvesting is for rebalancing your portfolio. Let's say that you have huge gains from one single stock X. Maybe because you are holding it for a long time or from your RSUs, but it makes up a big chunk of your portfolio. If you have losses from other securities in your portfolio, this is the time to rebalance. You can sell some of the stock X for gains and offset those gains by the losses from other securities. This will help you to reduce the concentrated risk in your portfolio. But if you do not have any losses to compensate for the gains, then you cannot really do anything to save taxes. Are there any other strategies for tax loss harvesting? Share them in the comments below. We will soon meet again in another episode. Thank you.